Most people who go through a divorce budget for the lawyer, they think of it as a legal process with a legal fee at the end. That is accurate, and it is also roughly 20% of the real financial damage. Divorce is not a legal event with financial consequences. It is a financial restructuring of everything you own, everything you owe, and everything you will earn for the rest of your life, wrapped in legal proceedings that most people do not understand until the bill arrives. The average contested divorce in the United States costs between $15,000 and $30,000 in legal fees alone. The total financial impact, when you count the tax events, the retirement account division, the credit score damage, the housing transition costs, and the income disruption, is closer to $100,000 to $200,000 for a middle-income household. Here is every cost nobody put in the brochure. Here is the conventional mental model most people carry into a divorce. There will be legal fees. Assets will be split. Maybe there will be alimony or child support. The process will be unpleasant, and then it will be over. Both people will rebuild. That is the story divorce attorneys, mediators, and the entire personal finance industry tell about the end of a marriage. It describes the outline. It leaves out almost everything that cost money. Life good. Here is the rest of it. Divorce triggers tax events, credit events, retirement account restructuring, housing market transactions, insurance changes, and estate plan revisions simultaneously. Every one of these has a cost. None of them appear in the conversation you have with a divorce attorney at the first consultation because a divorce attorney's job is to handle the legal proceeding, not to map the full financial aftermath. The people who understand the complete cost picture are certified divorce financial analysts. Most divorcing couples have never heard of them. Most divorce attorneys do not refer to them. The gap between what you are told the process costs and what it actually costs is where tens of thousands of dollars disappear. Here is the full cost stack that does not appear in any single document you will receive during the divorce process. Start with the legal fees. A contested divorce, meaning one where the parties cannot agree on all terms, averages $15,000 down to $30,000 per person in attorney fees according to a 2020 survey by Martindale Nolo. High-conflict divorces involving custody disputes, business valuations, or significant assets routinely exceed $100,000 per person. An uncontested divorce, handled through mediation, averages $5,000 to $10,000 total. The difference between contested and uncontested is not the complexity of the assets, it is whether both parties can agree. Every hour of disagreement costs approximately $250 to $500 in attorney time on each side. Then come the retirement account costs. Dividing a 401k, pension, or IRA in a divorce requires a qualified domestic relations order, called a QDRO. This is a separate legal document that must be approved by both the divorce court and the plan administrator. QDRO preparation fees range from $500 to $2,500 per account. If the QDRO is drafted incorrectly, which happens frequently because many divorce attorneys are not QDRO specialists, the error can result in unintended tax consequences, early withdrawal penalties of 10%, and the need to refile the document. A household with 3 retirement accounts, a 401k, a pension, and an IRA may need 3 separate QDROs. The cost of getting them wrong can exceed the cost of getting them right by a factor of 10. Now add the housing costs. In most divorces, one partner keeps the marital home or both sell it. If one partner keeps the home, they typically need to refinance the mortgage into their name alone, which triggers closing costs of 2 to 5% of the loan balance. On a $300,000 mortgage, that is $6,000 to $15,000 in refinancing costs, plus the challenge of qualifying for the mortgage on a single income. If both partners sell the home, they pay real estate commissions of 5 to 6%, plus transfer taxes, staging costs, and pre-sale repairs. On a $400,000, home total transaction costs can reach $30,000 to $40,000. Both partners then need to establish new housing simultaneously, often at higher combined costs than the shared household represented. Now add the tax events. If the marital home is sold, capital gains tax applies to profits above the $500,000 exclusion for married couples. After divorce, each person gets only a $250,000 exclusion as a single filer. A home that appreciated by $400,000 during the marriage may generate zero tax if sold while married and significant capital gains tax if sold after the divorce is finalized. The timing of the sale relative to the divorce finalization is a tax decision most divorcing couples make without realizing it is a tax decision. Attorneys do not typically flag this. The IRS does not send a reminder. Now add the credit score damage. Joint accounts, joint mortgages, and authorized user relationships all need to be unwound. If a joint account is closed with a balance or a joint credit card is not paid on time, During the divorce proceedings, both parties absorb the credit damage. Divorce proceedings take an average of 11 months in the United States. 11 months of financial limbo during which joint accounts sit unresolved is 11 months of potential credit damage. A credit score drop of 50 to 100 points during the divorce process can increase the cost of subsequent financing, car loans, and insurance premiums for years afterward. There are several specific cost categories in divorce that each operate differently and each go undiscussed in the standard divorce conversation. The QDRO gap. A qualified domestic relations order is required to divide most employer-sponsored retirement plans without triggering immediate taxes and penalties. It is not automatically generated by the divorce decree. It is a separate document that must be drafted, approved by the plan administrator, and filed with the court. Many divorce attorneys outsource QDRO preparation to specialists. Some do not flag the need at all, leaving the retirement account legally undivided even after the divorce is finalized. Correcting a missing or defective QDRO after the fact can take years and cost more than the original preparation. The community property trap. 9 U.S. states operate under community property law: California, Texas, Arizona, Nevada, New Mexico, Idaho, Louisiana, Washington, and Wisconsin. In these states, all assets and debts acquired during the marriage belong equally to both spouses, regardless of whose name is on the account or whose income paid for it. This includes credit card debt. A spouse in a community property state who did not know about their partner's credit card debt becomes legally responsible for half of it the moment the marriage ends. The debt does not need to be in their name. It needs to have been incurred during the marriage. The pension valuation problem. Defined benefit pensions are not divisible the way a 401k balance is. They require actuarial valuation to determine the present value of future payments. Actuarial fees range from $1,500 to $5,000. If both parties use different actuaries, which is common in contested divorces, the valuations can differ by tens of thousands of dollars and become a separate point of litigation. Police, teacher, and government employee pensions are frequently the largest asset in a middle-income divorce and among the least understood. The insurance cliff. When a marriage ends, a dependent spouse loses coverage under their partner's employer health insurance at the end of the month the divorce is finalized. COBRA continuation coverage is available for up to 36 months, but costs on average $700 to $1,400 per month for an individual. For a spouse who has been out of the workforce or works part-time, securing independent health insurance at an affordable rate may not be possible without marketplace subsidies. The transition from shared employer coverage to individual coverage is a cost that appears suddenly and is rarely budgeted for before the divorce proceedings begin. The estate plan reset. A divorce automatically revokes beneficiary designations on wills in many states, but does not automatically update beneficiary designations on retirement accounts, life insurance policies, or payable on death bank accounts. If a divorced person dies without updating these designations, their assets may pass to their former spouse by default. Estate plan revision costs range from $2,500 to $5,000 for a full update. More importantly, the failure to update is a documented and recurring source of assets passing to unintended recipients, which then requires litigation to resolve at costs that dwarf the original estate planning fee. What could possibly go wrong? Here is what the full cost stack looks like when it lands on a real household. A dual income household. Combined assets of $600,000, including a home, 2 retirement accounts, and a joint savings account. They believe they are splitting the assets evenly. Here is what actually happens. Contested divorce legal fees, $25,000 per person, $50,000 total. QDRO preparation for 2 retirement accounts, $3,000. Home sale transaction costs on a $400,000 property, $28,000. Refinancing costs if one partner keeps the home, $12,000. New housing setup costs for the departing partner, $8,000 including deposits, moving costs, and new furnishings. Estate plan revision for both parties, $4,000. Health insurance transition costs for the dependent spouse at $1,000 per month for 12 months, $12,000. Credit monitoring and financial advisor fees during restructuring, $3,000. Total transaction and transition costs before the first alimony or child support payment, approximately $117,000. On a combined asset base of $600,000, that is nearly 20% of the total marital estate consumed by the process of dividing it. Neither party budgeted for this, neither party was told to. The income disruption compounds it further. Both parties typically see reduced household income in the first 2 years post-divorce as they absorb duplicate housing costs, loss of economies of scale, and the career disruption that frequently accompanies high-conflict proceedings. A 2019 study in the American Sociological Review found that men's household income drops by approximately 25% in the year following divorce. Women's drops by approximately 41%. For households with children, the drop is steeper and longer lasting. Yes, this is real. In 2020, Martindale-Nolo Research published a survey of 4,000 people who had gone through divorce proceedings in the United States. The survey found that the average total cost of a contested divorce was $15,500 per person in attorney fees alone, with costs rising sharply when custody disputes or business valuations were involved. The survey also found that 44% of respondents said the divorce cost more than they expected, and that the most common financial surprise was costs unrelated to attorney fees, including housing transitions, retirement account division, and tax consequences. The QDRO failure problem is documented in IRS publications and pension plan administrator guidance. The Employee Benefits Security Administration, which oversees retirement plan compliance, has published guidance noting that QDROs are among the most frequently mishandled documents in family law proceedings, with errors including incorrect account identification, missing survivor benefit provisions, and failure to account for loan balances against the plan. The community property debt trap has generated significant litigation. In 2018, a California appellate court ruled in a case where a spouse was held responsible for credit card debt accumulated by their partner during the marriage despite having no knowledge of the debt and never using the card. The ruling was consistent with California community property law. The debt was incurred during the marriage. Both spouses owned it equally, regardless of awareness. If you are going through a divorce or considering one, here is what the full cost structure means in practice. 1. Hire a certified divorce financial analyst before you finalize any agreement. A CDFA is a financial professional specifically trained in the economics of divorce. They cost $200 to $400 per hour and typically save far more than their fee by identifying tax consequences, retirement account errors, and asset valuation problems before they are locked into the settlement. Your divorce attorney handles the law. The CDFA handles the money. You need both. 2. Do not sign a divorce decree without confirming the QDRO situation for every retirement account. Ask your attorney explicitly which accounts require a QDRO, who is drafting it, and when will it be submitted to the plan administrator. Get a timeline in writing. A divorce decree that does not include a properly filed QDRO leaves retirement assets legally undivided, regardless of what the decree says. 3. If you live in a community property state, pull your credit report and your spouse's credit report before negotiations begin. You may be legally responsible for debts you did not know existed. Knowing the full debt picture before you negotiate the settlement prevents surprises that arrive after the ink is dry. 4. Time the home sale deliberately. If your home has appreciated significantly, selling before the divorce is finalized preserves the $500,000 joint capital gains exclusion. Selling after finalization reduces each party's exclusion to $250,000. On a home that appreciated by $350,000, the difference between selling before and after can be tens of thousands of dollars in capital gains tax. This is a coordination decision, not a legal one. Your attorney may not raise it. 5. Update every beneficiary designation immediately after the divorce is finalized. Retirement accounts, life insurance policies, and payable on death bank accounts do not update automatically when your marital status changes. In many states, your will is automatically revoked, but beneficiary designations on accounts are not. Update them within 30 days of finalization. Do not wait for the estate plan revision to be complete. 6. Budget for health insurance transition as a hard cost, not an afterthought. If you or your spouse is covered under the other's employer plan, price COBRA coverage and marketplace alternatives before the settlement is signed. The cost of health insurance transition belongs in the settlement negotiation, not in the post-divorce budget surprise category. This is not financial advice. Please do not sue us. If this reached someone in the middle of a divorce who had no idea these costs were coming, share it. Or someone who is currently married and wants to understand the full financial structure before they ever need to. The channel grows when the right people find it at the right time.